All right, let's just dive right into this explainer. Today, we're demystifying FlexiCap mutual funds, and we're going to use the Bank of India FlexiCap Fund as our live case study. Whether you're building your very first portfolio or you're just looking to optimize an existing one, really understanding how these dynamic funds operate is absolutely essential for your long-term wealth creation. So here's our quick roadmap for today. We'll start by defining what FlexiCap funds actually are, then look at BOI's performance highlights, do a quick risk and volatility analysis, check out their market cap and conservative strategies, compare them to benchmarks and peers, and finally wrap up with the key advantages and takeaways.
All right, Section 1. Let's start by defining FlexiCap mutual funds.
So what exactly is a FlexiCap fund? The absolute crucial point here is that it isn't boxed into one specific market size. Under the official guidelines, as long as a minimum of 65% of the total assets are invested in equity, the fund manager has total freedom to adapt. Unlike multi-cap funds that force managers into a strict 25% minimum across large, mid, and small caps, no matter what the market is doing, this FlexiCap structure is totally different. It literally allows the manager to dynamically shift your capital to wherever the valuations and growth opportunities are actually looking the best.
Moving on to Section 2, BOI FlexiCap performance highlights.
26.31%? That is a massive number. That's the Direct Growth Plan's incredible annualized return since it launched back in June 2020. It's just a perfect showcase of what long-term compounding can look like when a manager successfully navigates that flexible mandate we were just talking about. And to put that percentage into a real-world perspective for a second, if you had invested 1 lakh rupees in this fund 5 years ago, you'd be looking at over 3 lakh rupees today. Out of the literal ocean of mutual funds out there, this specific fund is one of only 5 FlexiCap funds that actually successfully tripled investor money in just a 5-year span. That is pretty wild. Okay, Section 3, risk and volatility analysis. Now, high returns are awesome, obviously, but evaluating a fund means we really need to look under the hood at recent market volatility. You just don't capture those kinds of massive gains without hitting some turbulence. As fund manager Alok Singh pointed out, every bull market has many intermediate corrections. From 2004 to 2007, there were 8 or 9 instances where the markets corrected by 8 to 10%. I think this is such a vital reminder, especially for beginners. Don't panic over an 8 to 10% dip. It's a completely normal, expected part of wealth building. Markets are going to have dislocations for sure, but the whole goal is to look past those near-term bumps. And to actually assess true capital growth, beginners really need to look past those simple 1-year returns and check the underlying risk metrics. Think of standard deviation and beta as basically measuring the bumps in the road. Standard deviation shows the overall volatility, the ups and downs, while beta evaluates how sensitive the fund is to wider market swings. On the flip side, alpha and the Sharpe ratio measure the driver's skill. Alpha calculates the abnormal, excess returns generated over expected market returns, and the Sharpe ratio evaluates that excess return per unit of total risk. Basically, they tell you if the fund manager is actually generating enough extra return to make all those bumps worth your while. And speaking of driver skill, the BOI FlexiCap boasts a really impressive 8.01% alpha. So what does this actually mean? It means the active management is genuinely generating high excess returns well above what the market strictly dictates based on its risk profile. They aren't just sitting there riding the market wave. They are actively adding significant value through their stock selection and those dynamic market cap shifts. Right, let's jump to Section 4, market cap and conservative strategies. So where exactly is that 8% alpha coming from? And honestly, how risky is it? Let's break down how they distribute the money. The fund intentionally avoids a heavy large cap bias by keeping roughly 49% in large, stable companies. But crucially, it allocates the other half to mid and small caps, 18% mid and 32% small. This specific structural deviation from your average fund is exactly what allows it to aggressively capture domestic economic growth, while still holding on to that stable large cap anchor. But what if you're a conservative investor and you're kind of wary of that small cap exposure? Well, using this really excellent T20 cricket metaphor from the source, your portfolio absolutely needs sloggers for growth, but it also desperately needs anchors for stability. So a conservative investor can pair this high-growth FlexiCap fund with a 25% allocation in short-duration debt. That debt basically acts like a giant shock absorber during those rough market corrections we talked about, which keeps you from panic selling when the equity portion inevitably takes one of those 8 to 10% dips. Moving right along to Section 5, benchmark and peer comparisons. Because evaluating a mutual fund in a vacuum just isn't enough. We really need context here. First, let's check the baseline. The fund has consistently and significantly outpaced the BSE 500 benchmark across literally all major time horizons. Just consider that massive 3-year gap, 21.11% for the BOI fund versus just 10.78% for the benchmark. That is a huge outperformance, and it really highlights just how effective their active management strategy has been. Next up, let's contrast those returns against some of the major peer funds. When you stack it up against mega peers like HDFC and Parag Park, BO actually leads the pack with incredible 3-year returns of over 21%, all while maintaining a highly competitive risk-adjusted Sharpe ratio of 0.82. It's basically delivering market-beating returns without taking on a bunch of reckless, uncompensated risk to get you there. And finally, Section 6, Key Advantages and Takeaways. One massive structural advantage we have to mention is its base expense ratio, which sits at just 0.46% for the direct plan. When you're compounding your money over 5, 10, or even 20 years, high fees can literally feel like a heavy anchor just dragging your growth down. So keeping your investing costs this incredibly low compared to competitors ensures that way more of that 8% alpha actually stays right where it belongs, in your pocket. So the real takeaway here is this specific combination of factors. It's lower costs, a flexible mandate that boldly ventures into mid and small caps, and a proven track record of persistent alpha generation. It all adds up to make this an incredibly potent wealth-building tool. For the patient investor with a 5 to 10-year horizon, this fund has absolutely proven it can function as a highly effective core holding. Remember, it tripled investor money in under 5 years. I'll leave you with this somewhat provocative thought to chew on. Does your portfolio actually have the dynamic flexibility to weather the next market correction while still compounding long-term capital growth? Are you holding too rigid a portfolio, or can you adapt to the next market cycle? Anyway, I highly encourage you to keep exploring the math behind your money. Really understand these metrics and make sure your capital is working hard for you. Thanks so much for joining me on this explainer, and I'll catch you next time.